The S&P 500 just did something that usually makes investors feel better. Historically, it's also something that makes them ask harder questions. From its low in early April, it climbed back nearly 15% in under 60 days. Wall Street called it resilience. Financial media called it a comeback. But here's what didn't make the Chyron. The fastest stock market rallies in history have not consistently been signs that everything was fine. In several notable cases, they've been signs that something was still very wrong. And understanding the difference is exactly what this channel exists to explain. Here is the question worth asking. Not is the market going up or down, that's a prediction. And predictions are mostly noise. But what does the speed of this rally actually tell us about the underlying health of the market? Because speed in financial markets is not neutral information. A market that moves slowly upward over months is behaving differently than one that snaps back 15% in 60 days. Same destination. Completely different signals. Here's something genuinely surprising. 8 of the 10 best single days in S&P 500 history occurred during either the 2008 financial crisis or the dot-com crash of 2000 to 2002. The best day happened during the worst periods. This comes down to something called volatility clustering. When markets are under genuine stress, uncertainty spikes, the range of possible outcomes widens, and in that environment, both panic selling and panic buying happen with unusual intensity. A volatile market doesn't just produce big down days, it produces big up days too, sometimes in the same week, which means a 4% up day is not by itself evidence that a crisis is over. It may simply be evidence that a crisis is producing the kind of volatility where 4% moves in either direction become temporarily normal. Now let's look at 3 cases where rapid rallies told very different stories. 2002. During the dot-com bust, the S&P 500 ultimately lost roughly 49% peak to trough. But it didn't fall in a straight line. There were at least 4 separate rallies of 15% or more along the way. Each one looked like a potential turning point. None of them were. Because the underlying problem, hundreds of companies priced as though they generate enormous profits, most of which never would, hadn't been resolved. The fundamentals had to reprice. And they did. Slowly. Painfully. 2008. In late November, following the Lehman bankruptcy, the index staged a rally of roughly 24% over about 4 weeks. Serious analysts say that the index was overvalued by 20% NT over about 4 weeks. Serious analysts debated whether the worst was over. It wasn't. The market fell an additional roughly 25% before finally bottoming in March 2009. The banking system's solvency was still in question. Credit markets were still seizing. The rally was real. The fundamentals hadn't caught up to it yet. 2020. Now, the critical counterexample, because rapid recoveries aren't categorically a warning sign. Sometimes they're genuine. The S&P 500 fell roughly 34% in 33 days in March 2020. Then recovered almost everything within 5 months. And in this case, the rally held. What made it different? The Federal Reserve expanded its balance sheet by nearly $3 trillion within weeks. Congress passed $2.2 trillion in direct fiscal support almost immediately. And the cause of the crash, a pandemic, had a plausible endpoint that investors could model. The 2020 recovery was backed by the largest coordinated fiscal and monetary response in peacetime American history, plus a clear narrative about when the crisis would end. That's a very specific set of conditions. What the 3 cases together suggest. Rapid rallies are not inherently signs of recovery or danger. They're a signal to ask better questions. What caused the original sell-off, and has that cause been resolved or just temporarily sidestepped? What is the policy backstop available if things deteriorate? And what are the broader financial conditions doing? Which brings us to the most important part of what's happening right now. There's something unusual in financial markets right now that deserves careful attention. In a typical risk-on environment, when investors are confident in buying stocks, money tends to flow out of bonds. Stocks go up, bond prices fall. And because bond yields move inversely to bond prices, yields rise. That's normal. But right now, long-term Treasury yields are also elevated, and in some cases have moved higher during the same period stocks recovered. Stocks are saying things are getting better. Bond yields are saying we need more compensation to hold long-term U.S. debt. And the reason that second signal matters goes back to something we covered in the last video. $36 trillion in debt has to be continuously refinanced. When Treasury yields stay elevated, that refinancing costs more. The U.S. is already spending over $1 trillion per year on interest payments alone. Elevated yields mean that number keeps climbing. And unlike in 2020, where the Fed had room to cut rates aggressively and absorb trillions in new debt onto its balance sheet, the Fed today is in a more constrained position. Inflation is not fully back to target. The Fed is still running quantitative tightening, slowly reducing its balance sheet rather than expanding it, and the fiscal space that allowed a $2.2 trillion emergency package in 2020 faces real constraints today given the current debt level. None of this means the stock market rally is wrong, but it does mean the 2020 playbook, the one where the Fed and Congress ride to the rescue quickly and completely, faces more friction today than it did 5 years ago. That's a meaningful difference, and it's not being discussed in the same breath as the rally headlines. One more piece that often gets separated from the market narrative. While the S&P 500 has been recovering at the index level, some of the underlying data on the American consumer has continued to deteriorate. Credit card delinquency rates have been rising. Consumer confidence surveys have shown elevated concern about the economic outlook even during the market's recovery period. The stock market and the consumer economy are related, but they're not the same thing. The S&P 500 is heavily weighted toward large multinationals. A rally in these stocks doesn't necessarily mean the American household is doing better. And if consumer stress eventually translates into weaker earnings for companies that depend heavily on domestic demand, the fundamentals the market is currently pricing may need to be revised. That's the kind of slow-building pressure that doesn't show up in a 15% rally headline. If you have a 401k or any long-term investment account, the instinct when markets recover is relief. That's completely natural. But here's the question an institutional analyst actually asks in this moment. Not, should I buy more? Not, should I sell? The question is, what conditions would need to be true for this recovery to be durable? And how many of those conditions currently exist? In 2020, that question had a clear answer. Massive monetary support, massive fiscal support, a crisis with a visible endpoint. Today, the honest answer is more complicated. Some tailwinds exist. Tariff tensions have shown signs of easing. The labor market has not collapsed. But the headwinds are also real. Elevated rates, record debt, a Fed with less room to maneuver, consumer stress building beneath the surface. The picture is genuinely mixed, and a mixed picture, framed honestly, never fits inside a Chyron that says, markets recover. The S&P 500's recovery from its April lows is real. The buying is real. But the historical record on rapid rallies carries one consistent lesson. Fast moves deserve slower thinking. Big headlines deserve harder questions. And the conditions that made the last rescue work may not be identically available for the next one. Whether this rally reflects genuine fundamental recovery or a market still searching for its footing, those answers aren't in the headline. They're beyond the Chyron.